accounting students. Today we're going to start looking at our fourth section of our notes, and this section is called finance, sometimes called financial management. In this section we're going to be looking at how we manage the finances of the company. So far we've kind of been looking at, okay, if these, how do we work out the numbers, and if these are the numbers, what do they mean? Now we're going to be taking kind of a reverse perspective. We're going to say, well, what numbers do we want? Not what do we get, but what do we want? And what are we trying to manage those numbers? What targets are we trying to manage towards? And so there is a component, obviously, of the income statement. And in our financial analysis of the ratios, we saw how we could go and calculate those ratios. In financial management, we just do the opposite. We say, well, if we want a return on equity of, say, 15%, let's aim for 15%. What do we have to do to help get ourselves that return on equity? And obviously tools like DuPont analysis are very valuable for helping us figure out exactly where we need to intervene or which numbers we need to change to achieve those specific objectives. So definitely there's a very big financial performance, income statement component to financial management. But we've kind of covered that area already, so it's just a case of looking at it from a reverse perspective. What we're going to focus on in this section of the notes is more kind of a balance sheet approach. And so there are going to be three main sections. And in this first little section, we're going to look at the financing section, but we are going to look at the other two sections, which is the investing section and the working capital section. It almost kind of ties up a little bit to the cash flow. If you remember the cash flow, the first section was the operating section, where we look at the income statement results and we look at working capital. Well, that's going to be the first section of financial management. We're going to do that in the next video. Then the second component of the cash flow is the investing section, and we're going to do that as well in another video. And then the third section of the cash flow is the financing section, and that is the one that we're going to start with today. So what I'd like to do, though, is to take a look at our balance sheet. So we have our assets, our owner's equity, and our liabilities. And as we said before, the first section is about the income statement, so about the profit. It's a profit, and it also includes looking at the current assets and current liabilities, which we refer to as the working capital. So this would be one of the sections of financial management. And as I said, we've looked at the profit, the ratios already, so we'll be focusing on the working capital component, and we'll do that as the third in our series of videos. Then the next video we're actually going to look at is we'll look at the investing side. So the investing side, let's write this here, investing. This is where we're looking at the assets, and it's not so much a case of now saying, well, these are the assets we got. It's more a case of saying, well, what assets do we want? If we're making money and we have opportunities for new investments, which projects do we take on? Which projects do we invest in? And obviously the principles of time value of money and cash flows are going to be very important in terms of working out which assets are, or which potential projects are good projects to select. And then the third component, which we're going to start off with today, if we think of the cash flow statement, is the financing section. So the financing section, we're going to be saying, well, let's decide how we're going to fund these assets. And it's not accidental. It's not, oh, we end up with this much equity and we take out some loans because we need to buy more assets. It's very intentional. And companies will choose a specific level of liabilities to equity, in other words, debt equity ratio. And if you remember from our discussions before, if we think of risk and return, the more debt, the more liabilities you take on, the more that will push your risk in this direction and will obviously therefore increase the required rate of return for the equity stockholders. So it's a very deliberate intention of selecting a target debt equity ratio. Now we've already spoken a little bit about the components. So debt is typically in the form of bonds. We'll issue those bonds. It's like getting a loan from a lot of different people. We will pay a specific interest rate. We will use a commercial bank or merchant bank to help us fund those or issue those debt instruments. Yeah, it's probably not too much more. I need to talk about that for now. We will come back and talk about those merchant banks in a few minutes' time with respect to something called flotation costs. Equity again. How do we get equity? Well, there's two ways of getting equity. The one is to issue shares, which we might do as a straight issue. We can do them through a rights issue, which means that for every existing shareholder, we give them the right to buy a certain number of shares. And that's quite useful in that it doesn't disrupt the power balance within the different investors of the company. So issuing shares is one way. The other way is that when we make profits, instead of distributing those profits, if we keep those profits, that contributes towards equity. And the great thing with the profits is we don't have to go to a bank to get the profits. We're making those profits. So all we have to do is make a decision to keep them. So some of the equity will come for keeping our profits. Other will be for issuing new shares. And then obviously we will raise loans as well. Right. So now what I want to talk about is something called the weighted average cost of capital. And this is very important for the other sections we're going to do, because obviously if we think of debt, debt is low risk because those bonds are literally bonded over assets. So if something goes wrong with the company, assets are sold, bondholders get their money back. So they are low risk. So we'll call that RD, that's required rate of return of the bondholders. And then obviously the equity stockholders, there's more risk involved for them. And so they have a higher rate of return, which is RE. Now, clearly we have both equity and debt. And so what we try to think about a weighted average cost of capital is what is the average return we need with the combination of debt and equity that we have. So for based on this proportion and the required rate of return, what return do we need? Okay, and this is very important, this concept, because when we look at investment decisions, these assets are funded by those investors. So what return do they want? So it's easiest to illustrate by a little example, and I've taken the example that I put in your notes so you can go and look back to that. And basically we're going to need to look at two things: the required rates of return and then the weighting, the proportion. And that proportion might change slightly, but it typically is set by the directors of the company. They have a target debt equity ratio. So in our particular example here, the debt equity ratio is 0.4. In other words, debt is 0.4 to equity 1. So we add that up together, that gives us 1.4. So the weightings is 1 over 1.4 for equity. So they'll probably be around about just less than 70%. And then for debt, it'll be a 0.4 over 1.4. So you notice we add the two dollar values or proportions of the amounts together, and then equity is a proportion of the whole and debt is a proportion of the whole. Once we've got those weightings, we now need to look at the cost. Now, to get the cost, obviously that is typically market driven. So what is the going interest rate for this type of company with this level of risk and our credit score? That will determine what our cost is. In this particular case, we just made up a number and said it was 4%. And then for equity, what required rate of return do equity stockholders want? There are a couple of different techniques to work out RE. One is called the arbitrage approach. The other one is something called the capital asset pricing model. And you'll do more of that in Business 340 and investment management class. Suffice it to say, there are ways of working out what that required rate of return is for equity. Okay, so in this particular case, it's 12%. Now, there's one kind of tricky component here, and this will vary. It varies from industry. Prior to the Tax Act of 2017, where they gave kind of a lot of tax breaks to very wealthy individuals, up to that point, all interest for corporations on their borrowings was tax deductible. After that, only favored industry got tax deductions, obviously like property development. We would know why that would be. They got tax deductions, but some other industries didn't. So you would need to know that. For now, we're just going to assume all debt for large corporations is tax deductible, which means if you're paying 4%, it doesn't really cost you 4% because you get tax deduction on that interest that you pay. So we need to multiply that by 1 minus the tax rate. So we got 4 multiplied by 1 minus the tax rate, which in this case is 0.25. Doesn't obviously apply to equity. So now what we need to do is we need to multiply these out. So this is just straight 12% times that proportion. So we got 12 multiplied by 1 divided by 1.4. And this gives us 8.57. Notice I prefer not to put these in decimals, otherwise these numbers get very small and you can get lost in the decimals. And then over here, we've got, this is going to be 4 multiplied by that, which is going to be 3 times 0.4 divided by 1.4, which is 0.86. And if I add these up together, it gives me 9.43. So 9.43 is my weighted average cost of capital. That is the average return that my investors want from projects, from investments in assets. Okay, you need to know how to be able to do that for this class. The next 2 things you don't necessarily need to know about. We will cover them in other classes like Business 340 or investment management. The one is the idea is that if I issue shares or issue bonds, that's really difficult to do. And I'm probably going to need a company to help me do that, a merchant bank, and they're not going to do it for free or out of the goodness of their heart. They're going to charge us a fee or commission. And so say, for example, I borrow $100 and I have to pay 4% interest. I'm going to pay $4 interest. But how much money do I actually get? Well, the merchant bank's going to take a fee. So I only might get out of this $98. So if I look at my effective interest rate, it's not 4%, it's 4 over 98, which means it's probably closer to 5%. So I'm accounting for what they call the flotation costs. So what you would do is you take the 4% and then you multiply it by 1 minus the flotation cost, which I just assumed here was around about 2%. And that will give us our effective cost of our debt or equity, whatever instruments we raise. And this might be, I'm just guessing here, say 5%. Okay. The next thing I wanted to touch on very briefly is when we go and we raise more money, particularly when it comes to loans, the more money you borrow, the more risky you are to lenders, and therefore the higher interest rates they're going to charge you. So if we look over a certain period of funding, so this is our total funding over here. You know, if we take our weighted average cost of capital, and debt doesn't, equity doesn't change a lot, but debt does, is if I borrow like up to say 20 million, it might cost me an average of say, let me just make that 10%. But then if I go over 20 million, then it might jump up to 12% because people want more money because it's more risky. And then maybe if I go over 30 million, it's going to jump up to like 15%. And then over 40 million, it's going to jump up to 18%. These changes at certain thresholds are known as breaks in the weighted average cost of capital. Why are they important? Well, they're important because if I'm funding a project for say 8 million, that's fine. 10% is good. And I'll pick that project. But then if I'm funding another project for say another 15 million, that's gonna, I've got 8 and then it's gonna take another 15. That's gonna take me over here. So that stage, I need to be earning a minimum of 12% for that project. And any other project I take on, I need to look at, okay, what total level of funding am I at and what is my new weighted average cost of capital, because it does not stay constant. But for the purposes of this class, you need to be able to work out the weighted average cost of capital and obviously understand what it represents. So that's all from me on this section. The next section we're going to look at is going to be investments, the asset side, and then we also spend some time looking at the working capital management side. Thank you.